Okay, so I wanted to go over this problem with you all. First of all, this particular problem, it says McKnight Company sells flags with team logos, and McKnight has fixed cost of $450,000 per year plus variable cost of $10 per flag. Each flag sells for $25. So first let me erase all of this. So there's a few calculations you can do here that will make this a little bit easier. First of all, look at the contribution margin per unit. So if you take $25 minus $10, your contribution margin per unit would be $15. Your contribution margin ratio would be 15, the contribution margin divided by the sales, and if you divided that, your contribution margin ratio is 0.60. Now that's going to help you a lot. So how many would you need to sell this year to break even? So there's several ways you could actually do this. I mean, I didn't really necessarily do it the way that maybe the book would say to do it, but there's more than one way to work this. But you know you need to cover all of your fixed costs and have enough left over to cover your fixed costs. So that's the main thing that you need to know in order to break even. So if you take your $450,000 and you're making $15 on each, so 450,000 divided by 15 is the way that I would figure it out. You need to make 450,000 because you got to cover all of that, and your contribution margin or your profit on each one of these that you have left to pay off the 450,000 would be $15. So how many $15 flags do you need to sell? If you're going to make 15 to cover the 450, you would have to sell 30,000 flags. Okay, and then so let's scroll on down. The next thing it says is use the contribution margin ratio approach to compute the dollar sales. So we've already, we know fixed costs. Now our target profit is $15,000. So we already calculated the contribution margin ratio. Remember, the contribution margin is the sales price minus the variable cost. So that was $15. And then the contribution margin ratio was the $15 per unit divided by the sales price per unit. And that's how we got the 0.60. So we already have that. So if you take these two, divide by 0.60, that will give you $775,000. Now we want to prepare a contribution margin income statement for the year ended. And the important thing to remember is we're selling 26,000 flags. So 26,000 flags times 25 would give you the 650,000. The variable cost, remember the variable cost is $10 per flag. So if we sell 26,000 times 10, we get 260,000. Now when you subtract those, you get the contribution margin ratio of 390. Now that is not enough to cover all of our fixed costs, so we don't have enough to cover that, so we actually have a loss. Requirement 4, now we're going to increase fixed costs by 20%. So let's think about that. Fixed costs were $450,000. So we're going to have 100%, we're going to 100% plus 20% more, so 1.20. So our new fixed cost is going to be $540,000. And then also the variable cost is going to go up $250. So now our variable cost per unit is $12.50. So we're selling them at $25. So our contribution margin now is only 50%. Okay. So let's look at our question here. It says, under the expansion plan, the break-even point in units would be what? And then the break-even point in dollars would be what? The way I did this, I think that oops, I'll just go ahead and erase all that. I think the way I did it was I took the $540,000 divided by my new contribution margin ratio. Remember the contribution margin ratio, now our variable cost is $12.50 out of the sales cost, which was $25. So our new contribution margin ratio is 0.50. So if you do the new fixed costs we want to cover, our break-even point would be, we need to cover our fixed costs. We don't want to make a dime over that, just enough to get by to cover our bills. You're going to have to do $1,080,000 in sales. So that's where the dollar number comes from. Now, how many flags would that be? Well, you would take your dollar amount times $25. That's how much each flag is. And that should give you the $43,200 right here. And then the only reason we should take the expansion is if the profits cover or go over. We want the profits to go over the expected cost. So hopefully that will help understand all the calculations there are in question number 1.